Welcome back. And the crude oil prices remain elevated as the market keeps a keen watch on the turmoil in the Middle East. To discuss the outlook on oil prices and a lot more, I am now joined by Edward Morse, Global Head Commodities at Citi Research. Ed, hi, always a pleasure to have you here at CNBC-TV18. What's your sense on what's happening between Israel and Palestine right now? And with the war raging on for more than a week, how are you looking at the geopolitical premium, the developments that crude is getting impacted with?
Well, we're looking at the geopolitical development as one that is not quite as risky as what we were looking at 50 years ago at this time with the Middle East war, which was a genuine war. We have a risk of it becoming a wider spread conflict, but there seems to be nobody's clear interest in doing that. So at the moment, there's nothing at oil at stake. There are atrocities at stake. There's a very difficult time trying to deal with the Israeli effort to eradicate Hamas without doing further damage to people within that society. But that seems to be the intent of the government, and there doesn't seem to be much to stop it. There have been signs that there might be some exchange of rockets and the like in the northern part of the of Israel, but so far everybody's been restrained and nobody wants to break out. So it's a situation that's filled with risk to markets, risk to growth, risk to oil in particular. That risk is perceptibly higher than it was 10 days ago, but it's not monumentally high. It's not warranting all this concern about $165 oil.
Ed, so where would you see this year ending for the crude oil prices? There is a big range that banks and brokerages are working with for 2024. What's your sense for this year and the next?
Well, our base case is that prices will be going down to the high $70 range. It could be even lower. We've seen, how volatile prices have been in the last 2 weeks alone, and we continue to believe in that volatility. But unless the countries that have taken oil out of the market from OPEC Plus and particularly Saudi Arabia and Russia, unless they see a perceived need to cut production again, we see an inventory build on the order of magnitude of 1.5 million barrels a day next year. And this starts in the quarter that we're now in, where we're moving from a period in which we had inventories drawing by around 1.6 million barrels a day at the peak of the third quarter in August to an average growth in inventories. And even if that average growth is in the 300,000 to 500,000 barrels a day, that's quite a switch from minus 1.5 million or minus 1.6 million on an inventory draw to an inventory build. So that should show signs of weakness. And with it, we should expect to see financial flows, which have been a bit schizophrenic lately. They started the third quarter with a very low level of net length in the managed money part of the options markets. It grew as the extra cuts by Russia and Saudi Arabia hit the market. That net length grew from around 2.6 to 1 to around 13.6 to 1. That is relatively phenomenal, given that it's higher than at any point since even before the Russia-Ukraine war began. And then it collapsed to around half of that, and now it's back up again. So what we would be seeing, if we're right in terms of where oil inventories are going, is that net position getting shorter again, also assisting in bringing prices down to a lower level.
All right. Ed, you perhaps are the only one in last many days who hasn't talked about 90s and 100 in case of crude oil prices. So higher 70s is where the crude could be headed, is the Citi view. Also talk to us, Ed, about gold prices, which have been quite volatile. A $30 to $40 move in matter of 24 hours is something that we've been seeing many times over the past few months. With the prices at $1,900 and beyond, reports suggesting that we could be looking at an all-time high in the next year. What's your sense?
Sure. A lot of it is based on what happens to the U.S. dollar, and that is in part related to what happens with U.S. rates. So we know that eventually rates are going to come down. We don't know when they're going to come down. We know we've had another big spurt in inflation that the Fed is looking at. They're also looking at weakness in the market, so we don't know what they're going to be doing, but we suspect that we're going to go back above that $1,900 rate to a range above 2,000, hitting perhaps 2,100 by the end of the year. And that's kind of the macro role played by the dollar. There are other things at work, of course, and I would note that we've had this rise in the price of gold without a lot of financial buying. It's been a reflection of whatever other activity is taking place in the market. There has certainly been de-dollarization. We are seeing central banks increasing their reserve holdings of gold and decreasing their reserve holdings of dollars. That has not dramatically affected the role of the dollar as a transaction currency, but it certainly has had an impact on central bank gold holdings and to some extent private holdings of gold. We've seen Russian exports to China of the physical material increasing, and that and the macro uncertainty and the risk on issue are what's really driving it. The bigger driver is yet to come. And as I said, it will be when the U.S. changes its position from raising rates to reducing rates.
And would you equally be bullish on silver here? What are your projections? Do you see $30 coming up by the time we see next year?
Yeah, well, we have projections of silver going to above 28. We have projections of the gold-silver ratio getting tighter, which means silver going up more than gold. Part of that is related to an area of the global economy which is buffered against a lot of the macro headwinds, and that has to do with the silver need in solar panels. That need is increasing, not decreasing. Manufacturing of solar panels is going up. It's being subsidized in Europe and in the United States, as well as in China. So the three largest economies are seeing significant growth in demand for solar voltaic cells, and that means an increased demand for silver, which we see going from a mild surplus from a pure supply-demand balance basis into a deficit that will and should help the ratio between gold and silver changing in silver's favor.
And that brings us to the base metal prices, which have been under pressure here as well, except for zinc and aluminum. To some extent, we've seen very sharp declines actually come in for copper, for nickel as well. Steel, to some sense, also has been under pressure. The China stimulus measure that we keep talking about, do you see that coming in? What's your sense on data? And how are you putting strategies now on the metals?
So the demand on the ground has been dramatically impacted by the property sector in China. We don't see any dramatic increase in stimuli being provided to the factory sector, to the property sector. We have had a lot of volatility lately in copper. Copper is called Dr. Copper for a good reason. It is incredibly tightly correlated to the rate of GDP growth in the world economy. And that factor still sits out there with reductions in expectations of global GDP growth for 2024. Yes, economists raised their perceptions of growth over the course of 23. That largely had to do with emerging market countries, including India, largely emerging market countries in non-OECD, ex-China, Asia. We're seeing the effects of the decrease in Chinese trade activity on those countries. We are projecting ourselves a lower growth rate for the world in 2024 than 23. And with that comes less steel manufacture, a less increase in need for iron ore. This is happening at a time when iron ore supplies have increased both politically and on the ground. China, in need of cheaper iron ore, lifted its restrictions on importing Australian iron ore. We see iron ore, going down to below $100 a ton and staying there. We saw copper for a while trading well below $8,000 a ton, hitting 7,500, I'd say for, a day or two or a few hours or more, and then getting back above 8,000 significantly, and now sliding down again. We are medium term absolutely bullish on copper. That has to do with the need for copper wiring in electric vehicles, the need for copper wiring as power grids are expanded around the world. And with the surge in renewables, we expect power demand to increase both in the mini grid and the larger grids of the world, all of which becomes copper intensive. And we will see a point where a supply is undoubtedly going to be challenged, whether we're looking at the world's largest supplier, namely Chile, which is not seeing significant growth on the supply side. It takes a good 5+ years from the time we decide to increase silver mining until you get supply in the market. And our judgment is that we will see silver going up to 10,000 a ton, 12,000 a ton, and in our bull case, $15,000 a ton, namely double effectively where it is now, aided by some speculative activity perhaps on China exchanges more than on the LME, but yes, a very big deficit in copper, along with copper's traditional role as Dr. Copper.
All right. So very bullish in gold and silver and copper. But Ed, let's also talk about the agri commodities. And in India, we have seen various government curbs coming in, whether it has to do with exports or stock limits on various commodities and lower import duties to ensure that there is availability and affordability within the country. So whether it's about rice or sugar or wheat, the kind of curbs that we have around. And then there's a conversation about El Nino and Super El Nino in the next year. What's your sense for this sector?
Well, we look at commodities in detail, and we notice the either active or potential bans on such commodities in India as sugar, and that has had us leaning toward the bullish side when we look at where sugar prices are going. When we look at the row crops, yes, the Northern Hemisphere harvest season is not yet fully in. The Southern Hemisphere sowing season is underway. We're looking at yields of grains that are looking on the high side, rice aside, but looking at the internationally traded grains like the row crops, wheat, soybeans, and corn and the like. And yes, we've had some noise in the Black Sea on Russia not agreeing to what had previously been agreed through Turkish mediation and through the United Nations. But we have not seen a ripple effect that's strong. We have not seen, despite the concerns in emerging market countries of where those row crop prices might be going. We think that just as we look at sugar being on the bullish side of neutral, we look at the grains as being on the bearish side of neutral and potentially being on very bearish side of neutral.
All right, we have noted that, Ed. So bullish on sugar, but not so much on other commodities there. Thank you so much for taking time out for us here at CNBC. With that, it's a wrap on this edition of Commodity Champions. Thank you for watching.